For the shared equity, does the investor or beneficiary have to approve or like the property?
Okay, so same thing. It's just basically we want a home. It has to be within a certain area. Okay, so for example, if I say Simcoe, it's going to be the popular areas of Simcoe. It can't be like tiny beaches. I don't know if that's even in Simcoe, but it can't be like a farm property off. It'd be like Barrie, no problem. Yeah, that sort of thing. So, but we'll know. Like if you say, hey, listen, here's the MLS, here's my CMAs, they'll say right away, yeah, no problem. And the other thing too now is we can do this with an alternate lender, and we can do it with a lender, right? So we have two options right now. If I asked you, if somebody that showed a business for self individual that had $50,000 in savings for a down payment, that on paper their net income was 50,000, but we could help them buy $1 million property, you'd be like, what do you mean? We're self-employed, like, we're mortgage brokers, realtors, we're all self-employed. We know that we deduct everything that we can under the sun, so we don't have to pay Trudeau anything more than he's getting right now, right? So we want to make sure that we're reducing as much as we can. But then we go to a lender that just does stated income. So we'll use business bank statements for 6 months. We'll use the gross earnings. If you're a realtor, we'll use your year-to-date gross as your income, right? And you can buy a home with as little as the 5% down, whatever that price is, but it dramatically increases your purchasing power, especially business for self people. They're almost easier than people that are not, which is kind of against the people's way of thinking, because the problem with business for self people, they think they're going to qualify with the banks, and they won't. But we go to an alternate lender, and maybe 0.75% more than an interest rate is much more value to them than them having to declare more income, pay thousands of dollars of more taxes just to try and qualify for a mortgage of say 0.75% on an interest rate. It just doesn't make sense. And once we explain this to most business owners that understand it, they know exactly the channel that they want to go to, because they don't want to pay $40,000-$50,000 extra in taxes to qualify for a mortgage to save 0.75 on an interest rate. It just doesn't make sense, right? Next question.
Right. Does the borrower have to sell the house within 10 years?
Great question. Let's say, for example, after 5 years, I just want to get their equity position out. And maybe it might be better to do it sooner than later, because after 10 years, the equity position increases. I can choose to refinance. Okay. Now, there's a minimum criteria, there's a trigger amount or percentage that as long as it's over that percentage, no problem, you can do it. And it's between 6 and 7% rate of return that Arboro would say, yeah, you can refinance and pay us out. As long as it gets over that 6 to 7%, you're good. But if, let's say the market tanks and you're trying to refinance it there, they may say, no, we reserve the right to wait until it gets to whatever. After the 10 years and you want to stay in that home, that's the 10-year mark. We do an appraised market value at that particular time, and that's what it gets paid out at, right? So you can stay in the home. You don't have to sell, okay? If you want to stay in the home, it's just at the 10-year mark, that's when you would basically refinance and pay them out their portion.
Can the beneficiary or investor stop the sale because the prices have gone down?
No, sale is sale. So they actually have the right, let's say values have gone down and price values or whatever, they do have a right to make an offer for the property to purchase it, right? So let's say, for example, they want to keep some equity, they want to, keep the home, allow it to accumulate over time and then sell it. So they do reserve that right, but there's no restriction on you selling whatsoever. They won't stop a sale. Because if, people are in a tough situation or whatever it is, that's where their risk is, because they share that risk. The only thing is, again, it has to be at fair market value. You can't sell it to your uncle or somebody else at a discount. It has to be third party, arm's length, fair market value sale.
How long has this program or company been operating? Based on their company investment model, would they force clients to sell their home if markets do go down for a period of time?
No. Let's answer the first question first. So they're going into their second year because they've just had some renewals come up recently, right? So they're going into their second year. It's not an organization that has, mom and dad investing in it or whatever. It's owned by a corporation that has a lot of money behind it, and the money is not an issue. What they do is they raise certain funds, they get rid of those, and then they're doing another 50 million, they'll get rid of that, and then etc. Right? So that's kind of how they'll scale it. Now the question is, if the values go down, could they force them to sell their home? They don't want, if the values go down, I wouldn't want you to sell your home. I need you to wait till it goes up, because don't forget, they're not carrying the mortgage, you're carrying the mortgage, right? So basically that's where it is. And if values are going down, they're gonna say, geez, I hope these people wait until it goes back up, because then we're gonna make some money. But if it goes down, they're not gonna make any money, right? But there's no restriction. There cannot be a restriction on you selling the home, right? It's just you can't do it, and they don't want to do it. Understand the approach from this is more of a social responsibility type thing. How can we help people get into homes in a different way? And OFC has just, one of the things up to this particular OFC, is the governing body of, who allows finance. So they dictate all the rules, and they kind of came out with this program last year. Now OFC just came out and said, okay, shared equity is thumbs up. We approve it. So it's going to open the door for a lot of opportunities right now, and on the lending side, but for sure on the purchaser side, this could be huge for people to get into homes.
Are the mortgage rates higher in this program?
If it's qualify under the A lender, it'd be whatever the A lender rates are, and if I was going to an alternate lender, it would be whatever the alternate lender rates are. The program itself doesn't come with a rate surcharge at all.
Can we pay the shared equity plan in the first or second year after the purchase, another source, or does it have to be from the property itself? Can we pay without refinancing the property?
Yeah, 100%. It's just basically it'll be appraise of market value, and you got to pay them the amount, right? So if the rich uncle has some money for you, and or you just won the lottery or whatever, just do the appraisal. As long as it meets the criteria between 6 and 7% of rate of return on when you're doing a refinance situation, you don't actually have to refinance the property. You just pay them out that portion for sure. That's not a problem.
And then I think Arbor announced that they can underwrite deals with CIBC. Is that correct?
Yeah. So that's our A lender right now, and we're in the midst of signing up another A lender. I'm hoping it's going to happen relatively soon. And so that's who we would be doing it under the A side. And on the B side, we use Equitable Bank, right? So, and Community Trust are our two other lenders that we now do on the alternate side.
Are the qualifications the same for shared equity and rent to own?
No. So it'll depend on the lender, because you got to remember that we're actually doing 20% down with shared equity, right? So now we can go to a 30-year amortization. If it's with an alternate lender, we can take ratios a lot higher. Okay. If it's with the A lender CIBC, it's got to fit within their, 39, 42, that's with, I think 42 is their max on this particular program. So it does have criteria with that, but based on a 30-year amortization. If it's rent to own, I have to include, it's an insured product, and I have to use a 25-year amortization. So you're not going to have as much purchasing power with rent to own as you would with shared equity.
Now, what do you recommend for contractors with big cash income, but only 3 to 4% down payment?
Well, one of the things, start saving the down payment, because you need at least 5%. Okay. You'll need a little bit for closing costs as well, but your closing cost is shared based on your equity split. If you have a lot of cash income, because basically you got to understand, when we use stated income programs, it's basically we want registration of your business, and we want 6 months bank statements. Some lenders are asking for 12 months bank statements, but a lot of them are still okay with 6. And we add up all the deposits, the gross deposits, and then we deduct reasonable expenses against it to come up with a gross income, right? So it's more of a stated income approach. So with that, if I have somebody who says, yeah, I get paid in cash all the time as contractors, I'd say, listen, for the next 6 months, when you get paid in cash, put it in your bank account. Right? Because I can't show cash, but I can show a bank account, right? So part of it is when people come into our world, it's about coaching them how to take the next steps, right? And how to get there a little bit sooner and say, hey, this is where you are right now. Here's where we want to get you to. Let's come up with that plan, right? And maybe it might take a few months because just the way they position how they're taking their income in, right? But if I can show the lender the cash flow, right, and from the business and everything else, and they qualify, then day after, if they don't deposit the account, I don't care, because we just got them qualified based on what we show in the lender, right? But it's real. It's not cash under the mattress sort of thing.
In regards to rent to own, is a lawyer involved for the tenant and investor?
Yeah. So the investor has already kind of been pre-screened, and they'll have their own lawyer. And for the rent to own purchaser, they will need what's basically independent legal advice, right? So they would need to get their own lawyer to review the whole contract, make sure they explain to them exactly what it means, what happens if they don't make the payments, etc. So they have to fully understand everything. So they would need their own lawyer for that, for sure. I would encourage you, if you can block off a time for a strat, we can send you when we go through this, we'll talk about a little bit of strategies in terms of how you can leverage this program. There's some other ones I didn't go through as well, just for the sake of time, because I knew this one would take up a little bit more time. And just want to make sure that we're kind of all heading in the direction that we need to head in together, and we want to help you.